Good morning, everybody. We've got a busy presentation this morning because I've got some news, Richard's got some news, and Mahattie's going to be looking at what happened over the course of February. And then I'll be talking to the manager of GCP Infrastructure. So news-wise, for me, a bit of a more about Saba, and then something on Vietnam Enterprise, and then I'm going to hand over to Richard. Saba first. Obviously, we've had the first 7 requisitions. All of them failed quite spectacularly. Then they did 4 more. And then they've been busily withdrawing these. So on the 3rd of March, we had the news that they had withdrawn their requisition for CQS resources. And that just lets the board get on with the review that it was already doing. And it just reinforces Saba's tendency to time waste, really. And not just time waste, there's quite a lot of money goes into trying to fight off one of these attacks and advisors and everything else. It is all quite expensive and huge waste of time, given that, as we say, the board was already doing this. They are going to announce the result of their review in April. What I really hope is that they don't throw in the towel, because firstly, I do think there is demand for what it's doing. I think the management team is quite well liked and respected. It doesn't make any sense whatsoever to open-end this kind of strategy because it's got a lot of small cap and liquid stuff in it. And also because when you have a situation right now when commodities are out of favour because people are saying China's stopped investing, there's no more infrastructure investment, blah, blah, blah. And these things are all depressed. And cashing out now at the bottom of the cycle doesn't make any sense. This is now when the trust should be able to gear up and buy companies really cheaply so that when the cycle does turn, it would make a really lot of money. It has done in the past. Now, apart from the ones that we knew about because they'd publicly attacked them, Saba put up stakes in a large number of other trusts as well. And one of those was Montanaro UK Smaller. It's been doing all right things, buying back stock very regularly, trying to keep its discount down. But it looks like, well, we almost certainly did buy out Saba on the 4th of March. So it was a big, chunky buyback. It probably wasn't only buying their shares back on the day. It's because, as I say, it's been buying back stock very regularly, but it was most of the buyback that it did. I think we reported 7% discount, but when I checked the numbers based on the NAV that was published and everything else, I think it was about 8.5, something like that, which is narrow, but not really narrow. And one of the things that people are very sensitive to is the possibility that Saba gets preferential treatment. We really don't want to see that. And so it's very encouraging that Montanaro has been kept on buying stock back at around the same kind of discount level since. And we expect it to carry on doing that. So there is no argument here that it's sort of given it any favours. And you can see on the chart here, so this is a 3-year chart. Saba probably would have been building its position from about the beginning of 24. I mean, it's hard to know with all of these things because they're all done through stock swaps and everything else with Jefferies and Barclays and all these other big banks. And it doesn't necessarily put the shares in its name until quite late on in the process. But I'm not sure, looking at that discount, that it actually made much of a profit on these. Now, one of the things that Montanaro has done, I think this is quite like this anyway, it's put a new dividend policy in. So it's going to be paying out 6% of its NAV. I'm going to break down that sort of 1% a quarter, 1.5% a quarter as a dividend. So it's a fairly chunky yield. May have caused Saba some tax problems because it is more expensive for it and the way that it tax treatment in the States. And that might be right to sell out, but we just don't know. It's hard to tell all these things. But nevertheless, it's gone, and hopefully it will leave Montanaro UK alone. And then it's sort of like a sneak attack. Geiger Counter had a continuation vote at its AGM on the 3rd of March. And as usual, there wasn't an enormous number of shares actually voted. Only about 31.6% of the shares were voted at the AGM. Fortunately, it has a lot of loyal institutional type shareholders who like what it's doing. This is the fund that invests in the uranium and nuclear, basically. And they were voting for continuation. And so, the continuation vote squeezed through. But I know that looks like a reasonable margin. That is only kind of squeezing through. And had a couple of those institutional investors not turned up, it could have been lost. Or the directors could have been voted off. So we just do need to be really careful on these, that we do keep voting. And I know it's a rigmarole for some people, but especially where Saba's got a stake and the Herald is the one that springs to mind, do make sure you do vote your shares, because it Herald's got a continuation vote in its AGM, and we don't want to lose by mistake. Vietnam Enterprise, it's had a bit of a wobbly period. I suppose it's linked a bit to what Trump is doing, but not really. Its stock selection just hasn't been quite as good as some of the other ones, and its discount is quite wide. And so it's got a discontinuation vote at its AGM this year, and I'm guessing that they're a bit worried that there might be quite a big vote against that. So what they've put in place this morning is a new conditional performance-related tender offer of 100% of the shares. So if it underperforms the benchmark index, there's no kind of hurdle or anything else on top of that. If it just underperforms the index over the next 5 years, so by the 31st March 2030, then this 100% tender offer will be on the table at price close to NAV. And so you'll be able to get out. And then obviously if it shrinks too far, then they'll just want to roll the fund up. So, yeah, this is a good move. 5 years is a long time, but actually, as I've said before with these things, they shouldn't happen too often. You need to look at these things over the course of a cycle rather than just like what's going on year by year. Still with this thing, you still run the risk that you get a period where everybody's panicking in markets and they all want out, so the whole fund disappears just because everything was looking dark for this, so like 3 months or something. But that is a risk that this is prepared to take. One of the frustrating things about this, though, really is you can see how much worse it's performing than Vietnam Holding. And the same goes for Vietnam Opportunity too. And Vietnam Holding is still the smallest trust. I know it's trading on the tightest discount. I know it's issued a tiny bit of shares recently, but it's a shame that Vietnam Holding can't grow at the expense of these things that are trading it. There's no real mechanism for doing that I think of, but there we go. That's enough from me. I'm going to hand over to Rich.
M&A conveyor belt this week. It's Warehouse REIT. So this chart will be familiar with most of you, but just the NAV, which is the orange one, just popping up at the end there, just shows where we are in the market now. It seems we've hit the bottom and we're turning the corner. So these private equity bids are coming in now, and you see a little spike there in the share price. And we'll see on the next page why that is. That the company had an offer this week, or it announced it this week. The offer was last week. That Blackstone, which is US private equity, and Sixth Street sort of teamed up to bid for the company. The price was 470 million, which is 110.5 pence per share, which the board has rejected. And that was at a big premium to the share price, but also a big discount to their NAV, which, like I said, is sort of turning the corner now. So on the next page, we'll see the detail of the bid. So as has been the case with many of the real estate companies that have gone and the bids that have been tabled recently, private equity, and this really is a feeding ground for them at the moment. The discounts that are on offer to them and sort of the frustration with the shareholders, and they think they can get in there and get these companies cheap. So they took out last year Industrials REIT and a couple of years ago St Modwin, and they built up this private company that holds warehouses and industrial properties and stuff, which will be interesting in a few years' time to see how they exit that, whether they list that as one big massive industrial REIT again. That'll be interesting. But what they're attracted by is, like I said, the wide discounts, frustrated shareholders that may just want to get out. I mean, the guaranteed profits on these if they're buying them at discounts to NAV, and they're quality portfolios, and they've got reversion baked within them. So rental growth just through the portfolio alone, not alone added sort of asset management that the management teams are going to bring. And it's the bottom of the market. So that's why they're doing it. It still baffles me why there isn't any sort of read across from this, or there's nothing really happens with share prices after these bids, which baffles me. So private equity can see the valuation, but shareholders not at the moment. So consortium has until the end of the month to make their intentions known, whether they're going to make a firm bid or not. It may be unlikely, because if you read their statement, it said that they believe the bid attributed full value for the company and its future prospects. So that sounds like they're probably not going to come back with a higher bid. And if you read Warehouse REIT's statement, that they said they were in contact with their largest shareholder, which is Investec, with 15%, who seemingly were siding with the board in rejecting the bid. So we'll have to wait and see what happens with that one. Maybe someone else will come in with a bid, but we shall see. And then a couple of interesting moves. Firstly, from Supermarket Income REIT earlier this week, and then today, Urban Logistics REIT made a similar announcement as well. So they're proposing to internalise their management structure. So in Supermarkets Income REIT's case, so they're going to buy out the supermarkets team at Atrato, which is the investment manager, for just under 20 million, which seems quite princely to me. But they reckon they're going to save 4 million a year on costs by bringing it inside, which will obviously enhance their earnings and potentially see dividend growth going forward. But they're also going to transfer their listing from a close-ended investment fund to just a normal equity shares category. And they say that will reduce their administrative burden and potentially attract a wider range of investors. So within this proposal, the current principals that lead this, Ben Green, who's led it from day one, and Steve Wins are the same. They're going to remain at Atrato, and the internalised Supermarket Income REIT team will be led by Rob Abraham, who's been at Atrato for a number of years now and has been managing the fund. He's going to stay on, or he's going to be the new chief executive. And then Mike Perkins, who was appointed last year from Urban Logistics, actually, as their finance director, he will become the CFO. General meeting's been put in for 20th of March, and if passed, that will become effective on the 25th of March. And then with Urban Logistics, similar, exactly saying they're going to buy out their their investment manager, which is Logistics Asset Management, for an initial fee of 6.8 million paid in shares. They reckon that will save them 1.4 million a year, which again will be earnings enhancement and hopefully dividend growth. And they too will transfer the listing from closed-ended to normal equity shares. Within their proposals, there is an additional contingent payment on based on their share price performance. In the 3 months leading up to the anniversary of this, the average share price, if it is over 130p, they'll get 20% or up to 100% of that 5.6 million, depending on where that average price is. So if it's 158p, they'll get 100% of that 5.6 million. If it's 130p, they'll get 20% of that. And then if it's under 130, they'll get nothing. And that's all going to be issued and paid in shares at 114.3p. So it's really good incentive for them to do this. And they've got a 2-year minimum hold period. And it's going to be the same investment team. So Richard Moffat will be chief exec, Jamie Wardgrave, CFO, and Justin Upton will CIO. They've been there for years and running that. So there's going to be no real change there for them. They've not set a general meeting date yet, but that will come soon. And if passed, they expect this to become effective in the second quarter of this year, which is obviously April to June time. So the reason why they're both doing it, both mentioned administrative burden. Both mentioned that they hope it will attract a wider range of investors. And for me, that without saying it, I think what they're talking about is the cost disclosure stuff that's going on and impacting investment trusts and REITs at the same time, externally managed REITs anyway. So it's a double counting of their costs, which makes them look more expensive than the internally managed peers, or even if you were to invest in open-ended property structures. And obviously, if you've got large fees, it excludes some investors from looking to buy them or even holding their shares at all. And so I think that's where it's coming from. Maybe we'll see a few more follow suit if these cost disclosure rules aren't sorted out soon. Quickly go on the next slide. I want to talk about you could question with these cost saving stuff, or what is the point in external management? But there are a lot of benefits to it. So economies of scale for one. So the management teams don't just manage this; they manage many other funds, maybe some open-ended, some maybe other listed funds as well. So you get economies of scale from that. You benefit from a broader team, skills and wider experience. Just a couple of weeks ago, I was on the show talking about Tritax Big Box and the data center portfolio they're purchasing. That was all sort of from the investment manager and their capabilities and their skill sets, and been lining this up and working with the data center industry and power companies for years and stuff, and set up the JV. So they're benefiting from that externally managed structure. And also from a governance point of view, boards can oversee the performance, incentivize the management team and sack poor performing managers. So there are benefits to the external managed REIT regime. It's just a cost disclosure thing and a few other things that are sort of getting in the way, that perhaps behind some of these moves. And we'll see if any more follow suit.
Great. I'll now talk about what's been happening in the investment company sector over the last month. Actually, that was really interesting, Richard. Slightly worrying trend, isn't it, that companies are leaving the sector because clearly the investment company sector is not generating sufficient demand for them for whatever reason. And in a different sector, we saw Taylor Maritime Investments leaving, didn't we, as well. So, we'll have to see how that plays out. But anyway, for what is left, it was a reasonable month, actually, February. The investment trust index that I tracked was fairly flat over the calendar month of February, although it has dropped off over the last week or so. And there were actually some decent rises. And you can see on the list here quite a number of double-digit rises over the month. And I always look for themes, and sometimes there are no themes and they're special situations. But rather peculiarly, I think this month there are very definite themes for both the risers and the fallers. So I've picked them out here in some different colours. We can see, first of all, in the blue, the two takeover approaches. Warehouse REIT, which Richard just spoke about, and also BBGI Global Infrastructure, which I think is a done deal, that one. So some quite good uplifts from those two. In the red as well, we have the three Chinese country specialists, which all rose quite nicely over the month, actually. And I think a lot of that was down to the DeepSeek AI news, which feels as though it's been around for a while, but actually it was the beginning of February. And I think that challenged the existing narrative about US technology being utterly dominant. And I think actually this reminded us that there's some very good technology coming out of China as well, and that is competitive. So I think it refocused investors' minds on the potential benefits of investing in China. And then the majority here in green was a bounce in the very depressed renewable energy sector. And it's that which I'll really go on to talk about, because I think that was the main feature here among the risers over the month. You can see lots of good double-digit gains there. So I'll move now on to the fallers. Actually, a fairly similar quantum here. So just the one Geiger counter there, which James has spoken about, down 23% over the month. And a number of fallers. Again, actually, some very obvious themes coming out of this. And in red here, we have those really that are largely American. So we have the JP Morgan trusts here, which are very specifically American, and the tech trusts as well. They had some quite nasty falls, actually. And I think that was echoed as well by the healthcare trusts here in dark red, which are also largely US based. That's just the nature of that industry, that it's largely based in the US. So effectively, a big US sell-off here. And I think as well, the three Indian trusts, something of that same trend. There's a bit of concern about highly rated markets. So I will come on to talk about the US as well. But we'll start with the good news on renewable energy. And I did talk about this sector last month, actually, saying how depressed it was and how cheap it looked. But I could have said the same thing over many months, actually, and actually I have. So it's been quite difficult to time this one. But I do feel now that we're seeing some very specific positive action and news in the sector, which could herald a better period ahead. So I've isolated three types of things that I've noticed have been happening in the sector over this last month. And number one is asset sales, which has been an ongoing theme as trusts try to reduce their debt. And obviously some trusts as well are winding up. And that's really what the news was here. Secondly, a promise of more strategic reviews and strategic initiatives, which is a slightly different term. I was talking to one of the fund managers in the sector and asked him about his strategic review. And he immediately corrected me quite sharply, actually, and said, that's not what it is. We're looking at strategic initiatives. So that's a slightly watered down version, because with strategic initiatives, and the wording is, subtly important here, what they're saying is that they're not saying they're thinking about winding up or changing manager or really changing the trust in a radical fashion. They're looking for more marginal improvements, maybe in the fee structure, or they might be considering whether they could merge with another trust as the continuing party. Anyway, there's a bit more of that going on, which I'll talk about, and also much better news, I think, from the battery storage sector, which has been the most beleaguered of all of these sectors. It's been awful. And I think we're seeing really much better news coming out of that sector now. So those things combined, I think, are really important. I do sense that this is the foothills, really, of the recovery, and that we could be in the early stages of something. I'm expecting much more news. So if we have a look at a share price chart here, which is Aquila Energy Efficiency is the one that's really shot up, but another 4 trusts on this chart as well that have also had a decent month. And I think, you can see a bit of a turn here. This is a 6-month chart, and you can see for the first 5 months of it, they're basically all heading south. And then there is actually a fairly broad recovery over this last month. And I'm slightly nervous here about just getting excited about hearing the first cuckoo of spring and finding there's no follow through. But I think there will be. So maybe I can just talk about what's happened. And we'll start with the asset sales at Aquila Energy Efficiency. Now, this is a trust that's already in managed runoff. And it has been for quite some time, actually. I mean, it decided in June 23 to do this. So it's been getting on for 2 years now. And I think probably there's been a bit of impatience in the market, and it's very welcome news. There's quite a lot of relief that they have finally sold some some of their big assets here at a very good price. And I think the market was really very pessimistic, or maybe they were just ignoring this trust, because it was on a discount of 47.4% a month ago. And it's come in quite a lot now, but it's still 35% or so. And I think that indicates quite a lot of skepticism about the prices they were likely to obtain in the market. And that's not unreasonable. I can understand why people are pessimistic. If you're a known seller in quite a tough market, maybe you're not going to achieve very good prices for your asset sales. But actually, they have sold big assets in Germany and Italy, and they got a decent price. 31.8 million euros against the book value of 33.9. So that's a relatively small discount. And I think that's very helpful, actually, not just for this trust, but for the sector overall, because I think it does show that if you have decent quality assets, actually you can sell them at good prices. And I think this is very relevant for Harmony Energy Income Trust, one of the battery storage trusts, which is expecting to sell its entire portfolio, although there's no guarantee it's going to do that successfully. And we've been waiting for that news to come through. The period of for the preferred bidder is coming to an end now on 10th of March. So I do think we'll get some news on that shortly. And it's quite interesting there that the shares are trading still on a 30% discount, even though potentially they could get a decent price fairly close to the asset value if they sell it well. So that's one to watch. I'm certainly going to be keeping an eye on that one. So that's the asset sales. The next thing is the strategic initiatives. And we've seen quite a lot of these coming out. And I do think it's really interesting. Again, from a talk I was having with a manager, I think one particular phrase he uttered was really relevant. And he said that the board effectively had felt in the early stages of this market derating that it was a cyclical derating, fairly normal, a bit sharper than usual, but they felt they could probably leave the market to correct it. And now they've realized that the market is not going to correct it, so they have to correct it. And I think that's a really important shift in the mindset here. And I think we're seeing that across quite a number of boards now in the alternative sector, and they're now not prepared to accept the status quo, so they're all acting. So you can see here there's 3 that over the last month have all issued statements. VH Global Energy Infrastructure, engaging with shareholders, considering potential options. Don't know what those are. Bluefield Solar, that was strategic initiatives, not strategic review. And that's a strong trust. So I think that one will be able to sustain itself, but it might look for a merger. It might look for a reduction in the fees. There are certain things it can do there to improve its performance and I think its rating. And then Foresight Solar Fund, that's considering a range of strategic options. So that might mean asset sales, it might mean a merger, it might mean nothing much. But the good news is that I think we're now entering this fresh period of activity by these boards. So I think that's encouraging. So the last point here now, battery storage. Every recent update has been really good, actually. And we have heard from all 3 of these battery storage trusts. They've all said that actually trading in the key GB market was much better in December and January. In fact, they had some record months there. And this is after a depressed period where they weren't getting great revenues from this sector. So that's really welcome news. Again, it's quite short term, so we'll have to see if we get the follow through. But I think there's more news as well, in that these trusts have been developing. They're making very good progress with the energization of their portfolios, which means they're shifting from the development asset phase to the revenue producing phase. And that typically means you get an uplift in value at that point. So this is all very welcome. And I think there's a lot of scope here for positive surprises. And the valuations are undoubtedly very depressed. The Gresham House and Gore Street Trust are both on discounts of more than 50%, which is very wide. So let's have a very quick look at the US, market weakness there. 2 charts here. In both cases, the US is in red. On the left-hand chart there is plotted against the Euro stocks over the last 6 months. You can see there's a real inflection point at the start of the year where suddenly you wanted to have Europe and you wanted to shift out of the US. The other chart, also 6 months, is plotting the US in red against the FTSE All World Index in blue. And you can see there's quite sharp sell-off, actually, in the US market. And obviously, a lot of that is down to the geopolitical background. It's what President Trump's been saying about tariffs and so on. And I think as well, that news from DeepSeek was really important because we know that last year's rally was so much driven by the big tech companies that when a little cloud was cast over those, it did hurt the market. So just one more slide that just encapsulates a few of these points here. I think there was interesting talk actually at yesterday's AIC Directors Conference about the economics of President Trump. And I think we are going to see a near-term hit from all of this tariff news, although there's just been a pause, hasn't there, in the Mexico and Canada tariffs, so we'll have to wait and see. I think the real point is here, there's a great deal of uncertainty now entering the market. And my sense is that many investors who had good exposure to the US last year will find that they've accidentally got quite a lot more US in their portfolio than they ever intended, because, of course, it outperforms so much that maybe now, if you've got large holdings in very successful trusts like Polar Capital Technology or Allianz Technology, maybe a little bit of top slicing actually makes quite good common sense here. And I think that's particularly true as we are entering this new period in the tech sector now that China is undergoing something of a renaissance. And I think just on the very last point there, that's why India has sold off as well, because people are reassessing their exposure to these very highly valued markets. And against this rather risky looking geopolitical background, I think there's a good reason, I think, for selling out of some of those things now.
Great. Thank you, Andrew. That was interesting and useful, I think. Actually, I was writing some stuff. We were talking. There's a feature in my article this week. Let's see how we go.